Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by Market5. I'm your co-host Joel Elconin, along with Brianna Valesky, and we have Adam Sarhan on the line. He's the founder and CEO of Sarhan Capital, a boutique investment and advisory firm. Adam, how you doing in these confused markets?
So far, so good. That's the best answer we can give at this stage of the game.
All right, so the Fed decision didn't go over well. We break down. We can't take out the flash crash lows. The Fed bad numbers on Friday, bad jobs data. That means rates aren't going up. They pour money back into the market. Coming up near the top of the trading range we had before. What's your take on the overall market?
Sure. I think that the overall market is right now range bound. Your two things have happened that are really important. When we step back, before we put any money on the line, we always want to see what is the big picture, what is the macro picture telling us, and where's capital flowing at any given time. What we saw was a big topping pattern that happened in the S&P over the course of the first half of the year, all the way up until August. And then on August 20th, the S&P broke down below that important level of support that we spoke about on your show of 2040. It closed below there. That was the Thursday before the Monday flash crash. And then on Friday, the the Dow was down 500. The S&P fell hard. And then Monday was that 24th was that big fat flash crash low. Now what happened was, since that 3-day shellacking, for lack of a better word, the market literally has gone sideways to digest that very steep sell-off. But right now what you're doing is you're building a base under a base for the technicians out there, and the fundamental guys out there want to know where's growth going to come from. And as long as the S&P trades between 2020 on the resistance on the upside and then 1867 on the downside, by definition, we expect the sloppy sideways action to continue. Last week was a very important week for the market because you pulled back, you tested the August 24th low, but you held it in the S&P. The low last week was 1871. The low in August was 1867. And that's why these levels are so important, because they work time and time again. The Russell 2000, which is a small cap index, is a little bit more of a proxy for risk appetite for investors. That actually undercut its August low early in the week last week, but it quickly rebounded, and now you're back in the middle of the trading range. So what's happening here is that you're forming a classic double bottom pattern in the major indices, especially for the fact that the Russell undercut. That's actually a bullish event. From the contrarian standpoint, a typical double bottom, you want to see the right side of the W, undercut the left side of the W. And if the bulls can sustain this rally and since, mark the stock higher, you're probably off to the races.
All right. So, what we talked about earlier in the show yesterday, that boy, the dogs were barking and biting, and they were loud. You have stocks like Caterpillar, rallying $4. You have stocks like IBM getting off the mat. You got a 2-day run, and DuPont. A little bit is based on news today, so that's where investors are looking for value. Is that just combing the ditches here with these dogs? Is that overall a good sign for the market or a bad sign?
I think it's a good sign because what's happening now is two things. Number one, you have a fundamental shift in markets. I'm always asked the question about the Fed and what's the Fed going to do, et cetera, et cetera. Well, we've argued on your show and other places as well for many years. The Fed's not going to raise rates anytime soon. Even this year, with all the built-up anticipation the Fed's going to raise. Remember back in January, the Fed was talking about raising in June and September. June came and went, nothing happened. Then all of a sudden, there was all this pent-up demand and nervousness. They're going to raise in September. They're going to raise in September. The market cracked and fell hard in August in anticipation that the Fed's going to raise in September. What happened? 9-1 vote. Fed did not raise. What's happening now, all of a sudden, the market sold off after the last Fed meeting, and now the Fed's coming out one by one. Even Yellen came out and said, we're going to raise. What's happening is it's not the fact that the Fed, what they're going to do or what they're not going to do or any piece of data that matters. What matters is how does the perception, how does the market perceive the news to be, and how does the market react to it? The perception and the reaction are hands down the most important things investors can take away from any event, whether it's earnings, it's economic data, it's political data, fiscal data, monetary data, et cetera, et cetera. All that matters is what is the perception, and then how does the market react? Case in point was last Friday. Last Friday we had the jobs report. And the futures were down big. The jobs report missed, and they also revised lower August jobs number and July's number. So it wasn't only a miss in September, but they revised the past two reports lower. But stocks opened lower, but then they shook out and they actually rallied. And you had one of the strongest intraday reversals in a long, long time. So why? The question is why. So that day I put out a report, and it basically said the jobs report is bad for Main Street, but it's good for Wall Street. The reason is that right now, and we have all this anticipation with the Fed, and that at the beginning of this interview you asked me, well, it's a very confusing environment. I see a lot of clarity here. The reason why is because the confusion comes from if you listen to what the Fed's telling you, and then there's a disconnect between Main Street and Wall Street. Right now, Wall Street is ready for a Fed hike, period, end of story. Main Street is not. And that's the dissonance. That's the disconnect. That's the problem that investors are not able to understand. So that therein lies the confusion. Everyone is confused. Why is the Fed not raising? The Fed should raise, et cetera, et cetera. So if you dissect, they teach our kids in school to simplify the fractions, the least common denominator, right? So the same thing here. When investing, keep things simple. Right now, the Fed is between a rock and a hard place. It wants to raise rates, but it knows that it's data dependent. And the market, the Main Street, the economic data simply doesn't warrant a rate hike at this juncture. And that's the exact reason the Fed knows that. And that's the exact reason why they haven't raised rates.
All right, so let's look for value, where to put our money here under the scenario that you just described. A lot of anticipation of the higher rates, that the financial sector would be a beneficiary of it, and you had the rally, gave it all back, and then some. Your Goldman Sachs is made a new low from the flash crash. Your Morgan Stanley, I believe that was a multi-year low there. What do you think about these issues here? Based on the fact that it just doesn't look like interest rates are going up this year or maybe even next year.
Well, there's two thoughts here. Number one, the financials are one of the key beneficiaries of zero policy because zero policy helps the economic engine thrive. And the stronger the economy is, remember, these are all banks. And banks traditionally make their money from a strong economy. So the stronger the economy is, the better the banks do. And if you look back on weekly or monthly charts of any of these financials, they've had huge runs over the last 5-6 years. So right now, you're seeing a pause, which is normal, and then you're seeing these issues, specifically Morgan and Goldman, form double bottom patterns. And if the right side of this bottom, which is last week's low, holds, and that same case for the market, if those lows hold, you have a real chance to rally hard. If you look back at 1998, the NASDAQ did that. You had a big double bottom pattern, and then the market just took off like a bat out of you-know-what, and it shot up for the next, all the way up until the middle of March of 2000 when the NASDAQ finally topped out. But you had a huge run. So the same exact thing could be happening here in the major averages, also financials, where it's a pause. Let everything reset. You have to pull back a little bit. We had a 17% correction in the NASDAQ, which was a nice correction, almost bear market territory by a 20% definition, but you're not quite there yet. So the bottom line for investors, if last week's / August lows hold, we're range bound, or we move higher. If last month's highs are taken out, the resistance is taken out, the 2020 level or 2040 in the S&P, we're going higher. And until then, we're just range bound. That's what markets know right now.
Yeah.
The other side of the coin is that with the Fed, too, is that when the Fed's telling us they're data dependent, I argue, and I published this a few weeks ago, saying the Fed is market dependent, not data dependent. And you see that with every time they print money with QE 1, 2, 3, they printed money, the market was down. Okay, in 2009, the market shot up all the way to 10. All of a sudden, QE 1 ended. Stocks sold off hard. They announced Operation Twist and then QE 2. And then every time QE would end, stocks fell hard. They came out with another round of QE. So even right now, they said, we're not going to raise rates. Market sold off. They came out the very next day and the next week, and they said, okay, we might raise rates again. So they're very wishy-washy with respect to being data dependent, but they are there's no question about it. They are very market dependent.
Looking for leaders, looking for sectors here. We talked about some of the dogs getting off the mat yesterday. Not the same, though, for biotech. I mean, the darling sector of the last run up in the market really can't catch a break here. Is it just a matter of time here before the biotechs come back into play here? Or is it just we're going to have to look for new leadership in the market?
That's actually a great question, Joe. What I do with our members and our clients is that we have, Goldman Sachs has a conviction buy list. So I have a conviction leaders list. And what we do is we look for leadership at all times in the market. And what we do on findleadingstocks.com is we provide members and people with leaders. And we give buy points with my portfolio and give setups every week, et cetera, et cetera. But what we look for is we feel the market's fluid and leadership changes. And it's normal to see that complexion change from time to time again. So what we do at any given time, and what we've been doing over the last few weeks actually, is we move the cash before the August sell-off for the most part. And since then, we've been in cash. We began buying literally this week / on Friday, depending on our different accounts and everything. But what we do is when the market pulls back, this is the best time for you to filter out leadership from the pack. The stocks that refuse to budge on the downside are hands down the strongest stocks in the market, and they're the ones that are ripe to jump once the market gets back into gear. Excuse me, by the way, my voice, I'm getting over a little cold, so I apologize.
No, you sound great.
Okay, so yeah, so looking at the IBB or the biotechs, I think these are broken leaders for now. They don't constitute, they don't make the cut. I mean, really, to be honest with you, we've got a list we put together of 60 to 70 stocks that are just hands down leading the market, and they're like a coiled spring. You want to see the market just give you a little bit of a green light. Once you get that green light, these leaders are going to just blast off and take off. And those are the leaders. That type of strength, especially in a weak environment, is what we look for. And we focus on like a hawk, because once the market does take off, those leaders tend to blast off and be the first ones out of the gate.
Always looking for a catalyst in the market. We're on the line with Adam Sarhan of Sarhan Capital. Adam, guess what starts on Thursday?
Let me take a guess. It starts with E, the letter E?
Yes, it does. And it ends with an S.
Yeah, earnings season's right around the corner, and that's front and center, too, where right now we've gotten past the Fed, we've gotten past the jobs report. The next question becomes is how does the market react to earnings? And even with earnings, part of our exercise and our discipline, we go through earnings season and we cull stocks. We just literally look at the stocks that act the best after reporting the numbers. In other words, they gap up or they trade higher after reporting. And we separate the laggards, the ones that underperform or gap down. This way we know what areas of the market to avoid, and we know what areas of the market to look at. And the history shows us the biggest winners in the market tend to act well after earnings season. So in other words, the stock gaps up. Look at Netflix or Amazon this year. You've had breakaway gap after breakaway gap, monster gap ups after reporting numbers. Those stocks, it's not a mistake that they tend to rally for the next 6 to 12 months because they do very, very well, and the market's rewarded them for putting up good numbers.
Dollar. What about the effect of the dollar? That's been for like your Procter and Gamble's and some of these stocks. The strong dollar has hurt the exports here. Kind of holding steady here since the last earnings season. Is that going to be another faux pas for some of these companies with earnings?
Let me go back even further. You can go back to the dollar. You had a huge run up at the end of 14. The run up actually stalled the beginning of 15, and it topped out in March of 15. But if you look at the dollar right now, you're trading right near 95, 96, just under 96, 95, 99. You were literally trading there in January. The dollar hasn't gone anywhere all year. So it's really important to put these moves in the proper perspective. When you step back, look at a monthly chart, look at a quarterly chart, an annual chart, even a weekly chart, and you can see it. So what we do is every week we have a macro approach. We look at 4 real big areas. Look at equities, global equity markets. We look at bonds, we look at currencies, and we look at commodities. Now, within commodities, we look at energy, metals, grains, and softs, and, currencies, we look at all different crosses and things like that also. But just as a big picture, those are the 4 big areas that we look at. And then we believe that capital doesn't know any borders, and they'll flow to the area of the best ROI for the capital. So at any given time, where is your best ROI? And everyone's talking about dollar, dollar, dollar. Really, the dollar hasn't moved. It's been range bound since January.
Yeah, so it might not. Have as big an impact in earnings. We don't talk about the autos with you much here, and I'd been keeping an eye on that $30 level in General Motors, and this whole Volkswagen thing broke, and I just kind of got away from it, and then all of a sudden I look and here's it, at $32. Is this something you have in your portfolio? Or Ford? Make a comment on the stocks that are based in the Motor City.
Yeah, I think that's a great question. The way that you play the autos at this juncture, in my humble opinion, is to buy the auto retail parts stores. Look at the O'Reilly Automotive, for example. Look at Advanced Auto Parts, AAP. O'Reilly symbol's ORLY.
Okay.
Look at AAP. Look at AutoZone, AZO. Those are the leaders. Those are the stocks that we like to look at. They're basing now, they're moving sideways the last few weeks, right under new all-time highs, 52-week highs in many cases, and they refused to budge in August when the market got hit. That's how we find leadership. So the way that we play the autos, at this juncture, the auto retail shops are being rewarded a lot more than the auto manufacturers. So if you're able to go after, one or two different names, looking at leadership, and in that lens, there's no question that the the retailers are acting the auto part retailers are acting much, much better than the actual car manufacturers for many reasons. But leave it to say the market's rewarding that group much better than the manufacturers.
Okay, go into the strength as opposed to buying the weakness here. Any comments on the crude oil market?
Yeah, oil, again, if you look at a weekly chart of oil, it's building a handle here for the last 5-6 weeks, and that's perfectly normal. We've mentioned on your show, crude oil and other global commodities are trading like penny stocks, and they've been for months and months and months, if not years. What you're seeing now in crude oil for 2015, it's almost unprecedented volatility. You're seeing 5 to 10% daily swings, and that's not normal and it's not healthy. But also understand that crude's in a bear market. And so are all the other big commodities as well. Almost every major commodity in the world, except for one or two, are in a bear market. And that forecasts a recession and or a major slowdown in the global economy. And if about 45 minutes from now, the IMF is going to come out with their global forecast, and they're probably going to downgrade global growth. And the IMF and the World Bank and other big agencies around the world, the OECD, have all came out and said, listen, global growth is slowing. If you look at the market, crude oil in the last year is down over 60%. If that doesn't tell you loud and clear that global growth is slowing, I don't know what else does. And the transports also, they're very correlated also to global growth and also U.S. growth. And the transports are down in correction territory. So that's really important to understand that right now you've had a lot of volatility in crude. The last 4, 5, 6 weeks, you've moved sideways to digest that move. And now it's actually it's constructive for the first time in a long time. And your range bound, if you're able to break out above, I would say, $49 in crude, you're going higher. If you break down below 43, you're probably going to go down and retest that 37.75 low. And if you break that, good night, Irene.
Is it worth trying to play with the options markets, or you just don't know how long it's going to persist before it finally makes the move?
Well, it depends on your strategy. So if you want short-term options, you definitely can play that because you can sell weeklies or even monthly calls and or puts again if you expect this trading range to continue. But if you're looking for that move to the volatility to continue, which is most likely the scenario in these type of very volatile markets, you could put on straddles or you could buy longer-term options, whether they're calls or puts, to express a specific view. But it's a complicated answer to a complicated question. Yes, the short answer is yes, you can express them with options. Then the question becomes, how do you express them with options? It all depends on your risk tolerance, your objectives, et cetera, et cetera. But the point to keep in mind is that these major commodities that are trading like penny stocks, that's not healthy for the overall structure of the market. And if we're going back to equities for a second, the two bullish points for stocks is that, one, rates are at zero. We haven't seen a bull market end with rates at zero. And two, so far the PE for the S&P is right around 18. That's fairly valued, so to speak. We haven't seen a bull market in recent decades end with the PE in the mid-teens. So that's the bullish side of the equation. The bearish side of the equation is that every bull market in history had a beginning and an end. We're 6.5 years into this bull market. You had a major top form in the summer. You had major support break on August 20th, and you haven't been able to repair it, and you're still below all the major averages. Earnings are slowing down, the global economy is slowing, et cetera, and the Fed, has lost control over the market by compressing volatility. So that's the two sides of the coin. We don't predict anything. All we do is we interpret what we see happening because we know what's happening right now. By definition, no one knows what's going to happen tomorrow. We do have a view, a world view, and then when the facts change, we change as well. But as of right now, I would be cautious on any type of major investment due to the sheer uncertainty out there and the wild card. If the Fed comes in one day and decides to do another round of QE or QE4, which is very likely, the bearish argument goes right out the window.
Adam Sarhan, founder and CEO of Sarhan Capital, talking earnings, macro, commodities, just about anything we throw at him. Adam, thanks for coming on. As usual, we'll speak to you again soon.
Thank you.
All right.